Wednesday the 22nd. Good morning, folks. What are we talking about? Well, Trump extending the Iranian ceasefire. There are no talks, though, and yes, the Strait of Hormuz remains firmly closed. Lufthansa cancels 20,000 flights to save fuel. United Airlines cuts its guidance. The cost of the conflict is starting to become clear. And Kevin Warsh says he is not a sock puppet, and that Trump has not demanded that he cut rates, Tom.
European markets are currently flat. We came in this morning, they were pointing negative, but then you had some lines out from Iran, at least the state news agency suggesting they were seeing some signs that the US might be ready to ease that naval blockade, and things turned around. US futures are pointing to gains on the S&P E-minis of 0.5% on oil. Slightly lower now at 0.5% lower and just below $98 a barrel on Brent. WTI is also a little softer in terms of pricing, down 0.8% at $88.92. The countdown to the opening trade starts right now.
Wednesday morning, good morning. Okay, this is the situation as we now find it. We'll talk about the latest headlines in just a moment. But the left tail risk of a re-escalation of the kinetic conflict in the Gulf appears to have been removed. Trump has extended the ceasefire and removed that risk. So it looks like we're not going to see boots on the ground as a risk. The market can discount that. That's good news. That's upside kind of risk. However, the Strait of Hormuz is still closed. Oil prices are still elevated. Yes, they're ticking down a little bit on some kind of slightly unconvincing headlines that we are seeing right now that we don't really know kind of where they're going to take us. So we're going to see elevated oil prices, and the effect of that is starting to become clear, Tom.
And that's the point. The messaging around this has been so mixed from both sides. So I'll just quote from the Iranians on this that did move the markets, but it's paired some of the gains that we had seen in terms of European futures. We have received, I'm quoting, we have received some sign that they are ready, the Americans are ready to break the naval blockade. As soon as they break this blockade, I think that the next round of the negotiations will take place in Islamabad. So that is from the Tasman news agency. We'll keep across that, of course. But to your point, we are now in a situation where we have potentially a prolonged ceasefire, but deep question marks then about how long the Strait of Hormuz itself remains closed. And it's a reminder that the complexities there and that resolving this could take some time. And that is the impact for the global economy. As Vitol says, a billion barrels of oil are now off the markets as a result of that. Just to remind it, the JCPOA, so the Iran nuclear deal that the Obama administration negotiated, took 20 months to negotiate in detailed discussions. This is potentially a longer time frame in terms of how you keep the Strait of Hormuz and how you manage to reopen it. And that seems to be a clear takeaway for the markets.
Trump has indicated that he has no intention of ending the blockade at this point in time. So while the Iranians can go, we think that we can restart talks if that happens, at the moment there doesn't seem to be any indication that that is going to happen. So we end up, to your point, with this stalemate of the Strait being closed, kind of nearly closed, almost completely closed. And that is something that is going to feed through into inflation and the corporate results that we're beginning to talk about.
And we have inflation data crossing from the UK right now. In terms of month-on-month, CPI coming in slightly above the survey, 0.7% for the UK in terms of month-on-month CPI for the month of March. Year on year, it's in line with the survey, 3.3%. That's above the February print of 3%. Services, interestingly, stickier once again, 4.5% on services. The survey had been for 4.3%. So we watch the pound currently at 135. You've seen a bit of a pop early in the session, but currently just up, just a shy of 0.1% at 135 on inflation data that's a little stickier than the survey.
OIS swaps, OIS. The swap is included in that, are basically pricing 40 basis points of hikes at this point in time. Is this a number that can shift that higher or lower, I think, is the key question that we'll be watching out for. You can break it down. You can go onto the terminal and break down exactly what the sort of the core components are of the CPI number. It gets filled out over a period of time. I'm waiting to see what the increase in diesel, petrol, lubricants, etc. has been within these numbers. You are seeing a corporate effect already beginning to show through. The airlines, unsurprisingly, are maybe one of the first places you look. Lufthansa announcing overnight that we're going to be seeing 20,000 summer short-haul flights being cancelled. Unsurprising that that is what we're going to see. Let's see if the the other carriers around Europe do something similar. Michael O'Leary has talked about the fact that he's got kind of visibility into mid-May, but not beyond that. You've seen Scott Kirby over at United overnight as well, after the bell yesterday, lowering guidance at United. So we're going to be talking to him a little bit later on. I'm really interested to see what Scott has to say on his numbers. Alaska has completely withdrawn guidance. US carriers don't tend to hedge as much, Europeans do. But does that hedging work if there is no fuel available? Now, the European Union says there is fuel available in storage and it could release it, but it's not going to be in sufficient quantity really to deal with this crisis that the European airlines are likely now to face.
And just a reminder, jet fuel prices have doubled since the start of this conflict. Lufthansa saying that they think they can save about 40,000 tonnes of jet fuel on the back of these cuts to some of these routes. You have the analysis on one of the Bloomberg stories today suggesting that for the month of May alone, globally, airline carriers have cut about 3% of capacity. Do you expect that further to shrink the more this goes on, the longer this goes on, as airlines adjust? How can you put out 2026 forecasts with the uncertainty around the fuel price story right now?
So that's demand destruction that we are going to see. And clearly, I think airline prices are going to remain elevated as a result of it. But there's demand destruction. It's interesting. We're going to be speaking to the Akzo Nobel CEO very, very shortly. They've got numbers out this morning. Middle East impact, raw material inflation versus pricing. They're basically recooking the 2021-2022 playbook that they saw when they raised prices aggressively. Middle East price increases announced to fully offset Middle East impact, they are saying. So price increases coming through in the paint sector and the coating sector. So that's where the kind of the inflationary component is. The airlines may be seeing some demand destruction as a result of this.
And on Akzo, some of their competitors have raised prices. You talk about 2022. It was a different economic backdrop then. So can their customers absorb those price increases? How is that going to filter through in terms of second round and third round effects? All of this has to be weighed up by central banks, of course. And we had the Senate Banking Committee scrutiny, of course, of Kevin Warsh yesterday. And there were two key takeaways. One, he committed to being independent, not going to be, quote unquote, the sock puppet of President Trump, but also saying he does want significant change at the Fed in terms of communication, in terms of the balance sheet. Didn't give a lot of details on the balance sheet question, something he's been quite consistent on in terms of wanting to shrink that. We know the Treasury is concerned about the pace of any shrinking of the balance sheet. But he really pushed on independence and the fact that he does want to see some structural change at the Fed.
Yeah, that sock puppet thing is going to stick, though, isn't it?
It's quite the line.
Yes.
Quite the line. But there's so much uncertainty about who is actually going to lead the Fed. He may get the votes, but then we come down to Tom Tillis and whether or not he allows this to go through.
So it was interesting. I don't often like to talk about our opposition, but Joe Conan on CNBC had an interview yesterday with President Trump, and Joe tried to present the argument that you basically let Congress handle the investigation into the cost overruns at the Fed in terms of the building projects, and therefore the Tillis vote can come back and you can clear Warsh to become the next Fed chair. The president was having absolutely none of it, because that's the argument that's now being raised. That you can, and Tillis is pushing this argument as well. Give it to Congress, let that investigation roll through.
That's the off-ramp.
That's the off-ramp. But the president would not take that off-ramp yesterday, which I think is interesting. And therefore, you also have to assume that when Warsh talks about the idea that he's not the sock puppet, and he says the president has not asked him to cut rates. The president, every day talks about it almost. Rates are going to go lower when Kevin gets in.
The president's been pretty clear. He will be disappointed if the next Fed chair doesn't cut rates as soon as they get in.
OK, let's get back to those cost increases and price increases. Greg Pou-Guillaume is the Akzo Nobel CEO. He's going to be joining us very shortly. We'll talk about what he is seeing in terms of what the business looks like right now as a result of the Gulf story. Patrick Brenner, Schroders Multi-Asset Chief Investment Officer, joining us a little bit later. And we've got inflation data out of the UK this morning. There's plenty going on in the UK right now. Victoria Clark, Santander CIB UK Chief Economist, joining us later in the show.
Here's what else we are thinking about throughout the day then. Today, EU ambassadors will be meeting to discuss unblocking a much-needed €90 billion loan for Ukraine. At 12 p.m. UK time, the Prime Minister, Keir Starmer, will take PMQs in the House of Commons. No doubt more questions about Peter Mandelson and the fallout of that controversy. And 3 p.m. UK time, Eurozone consumer confidence will come through. We'll mark that for you, of course. 6:30 p.m. UK time, we're going to be hearing from Christine Lagarde of the ECB speaking in London. And later on the earnings front, Tesla, IBM and Boeing earnings as well.
Okay, what else do you need to know this, Wednesday morning? Bloomberg has learned that Deutsche Telekom is considering a full combination with its American arm T-Mobile. The German telecommunications firm is already T-Mobile's biggest shareholder with a roughly 53% stake. Such a deal would create the world's biggest wireless operator by market capitalization, surpassing China Mobile, which is currently valued at around $235 billion. The move would also rank as the largest ever public M&A deal. Let's get to the chip sector. ASM International is forecasting stronger than expected second quarter revenue, driven by continued investment in artificial intelligence. The Dutch chip equipment maker says revenue will be around 980 million euros for the 3 months to June. That's almost 100 million above the average analyst estimates. The company says growing AI adoption and rapidly scaling workloads are increasing demand for compute capacity. And Bloomberg has also learned that a small group of unauthorized users accessed Anthropic's new Mythos AI model, which the company itself warns could enable dangerous cyber attacks. According to a source and documentation viewed by Bloomberg News, users in a private online forum gained access on the same day that Anthropic announced a limited test release of the model. The group has been using Mythos regularly since then, though not for cybersecurity purposes. So when I saw this headline first thing this morning, I was like, that does not sound good. But it sounds like this is actually reasonably contained. Yeah, well, Anthropic say they're looking at it. Of course, this is a third party. It seems like it's a third party contractor for Anthropic that was one of the individuals in this Discord group. And this group, this private group on Discord, they basically search the internet and try and find access to models that have not been released, finding backdoors to do that. And it was a third-party contractor who apparently enabled that to happen. But importantly, to your point, on our reporting, this is not a group of people who want to use this for cybersecurity reasons. They're basically a bunch of geeks who want to understand how the models work before they're actually released and are playing around with them. So it doesn't seem like there's an immediate cybersecurity risk, but it does remind us that Anthropic and others building these frontier models need to make sure they have the it's not 100% secure, the ring fence.
Yeah.
Okay. I read it, and it certainly, given the risks that we've been talking about, sounded highly concerning. But as you say, maybe not so. Coming up, Kevin Warsh facing a grilling from senators, someone who's talked about AI and what that will do to productivity and potentially allow for lower rates. Seeking confirmation, of course, as the Fed chair. We're going to get analysis on that contentious hearing. Plus, the Strait of Hormuz remains effectively shut despite President Trump's ceasefire extension. We'll discuss the risks ahead for energy and shipping. Up next, we're going to be joined by Catherine Nice, Chief European Economist at PGIM Fixed Income. If you have any questions of your own for our guests, do send them to us on IB plus BBTV Go. This is Bloomberg. It is 7:15. Good morning. We are 45 minutes from the opening trade. European futures pointing higher by 0.1% after 2 days of losses. President Trump saying he's extending the ceasefire with Iran indefinitely, even as plans for a fresh round of peace talks collapse. The Strait of Hormuz remains closed to shipping effectively, with Iran saying it will not reopen the vital waterway while the US maintains its own blockade. For more, we are joined by Bloomberg's Jumana Pisechi in Dubai. Jumana, there's been a lot to digest out of the region just in the last few hours. We've had an update, it seems, from the Iranian state news, which has led to a little bit of optimism in the markets. The ceasefire has been extended, but the Strait is not reopened. Get us up to speed on what the situation currently is.
Another very busy 24 hours in the region. And remember, yesterday we spent the whole day pretty much ascertaining whether J.D. Vance was going to make the trip to Islamabad for a second round of talks. Clearly, that is not going to happen. And we found out in the middle of the night yesterday, President Trump putting up this Truce social post saying that the ceasefire has now been extended. But again, with a big question mark, because there's ambiguity really over the timing or the new eventual deadline for the ceasefire. He says it will continue until Iran submits a new proposal and discussions are concluded one way or another. He says that they extended the ceasefire at the request of the Pakistani mediators. And of course, we know that Pakistan Pakistan have been hustling really hard to bring the two sides back together again. But of note here is President Trump once again reiterated that the U.S. naval blockade is going to stay in place. And this has been one of the key conditions that the Iranian delegation have said needs to be lifted. The U.S. naval blockade would need to be lifted in order for them to return back to the negotiating table. And indeed, we heard from the Iranian Foreign Minister Abbas Araghchi overnight. He put up a post saying blockading Iranian ports is an act of war. It's a violation of the ceasefire. And striking a commercial vessel is an even greater violation. A short while ago, we also heard from the Iranian ambassador to the UN. He was giving an interview to Iranian state television and said that unless the U.S. lift the naval blockade, then there is no hope of a second round of discussions. So we are in a situation now where, yes, on the surface, there has been a ceasefire extension, so that is good news. But at the same time, this is not a state of war. It is not a state of peace. There is not a final resolution. The strait is still closed. And there's still a reasonable chance that both sides can return back to hostilities. It wasn't just that long ago that President Trump said that the army is locked and loaded and ready to go. And equally, the Iranian side keep putting forward messages saying that they are ready and are preparing themselves to return back to the battleground again. So again, a lot of ambiguity about where we go from here.
Jumana, great update. Thanks very much indeed. Really useful stuff. Jumana Basekci joining us out of Dubai with the latest. A lot of uncertainty still out there. So let's figure out what we do with it. Catherine Nice, Chief European Economist at PGIM Fixed Income, joining us now. Catherine, we seem to have, at least for now, and I hear what Jumana's saying about the possibility of conflict returning, but at least for now it appears that we have taken off the kind of extreme left tail risk, which is a resumption of the conflict. But we still have a Strait of Hormuz that is closed. What does that tell you? What are your models telling you about kind of where we are in this process, about the economic damage that is being done?
Yeah, I don't think a model is going to help you in this situation, I'm afraid. It's a very uncertain and unknowable thing. I think I would very much amplify the points that Jumana made, that it's sort of, on the one hand, it seems like, marginal good news overnight with having this extension. But on the other hand, the fact that these straits are being blocked now by the United States, my understanding is that this is quite existential for the regime, in a different way economically, but that, the constraints are no less binding. And I don't think that we can completely rule out a return to, a kinetic situation there. I think what that means is that even in a best case scenario, because of this prolonged uncertainty, I think we can assume that there is going to be a pretty big risk premium baked into these energy prices, that they're not really going to go away anytime soon. And that means, higher for longer energy prices are going to be more impactful on inflation. You see that already in the UK numbers that just came out today.
Okay. I think we've got a slight problem with I can hear you, but I can't see you at the moment. So we'll carry on the conversation, but maybe put up some graphics. Catherine, let's talk a little bit about what the economic impact is going to be here. Whether or not we are... Is demand destruction the biggest risk, or is inflation the biggest risk right now? Or is it just a combination of the two? The bond market at the moment is painting a moderately kind of sanguine picture. The equity market's in its own little world, but the bond market is taking a slightly more cautious view. What is your assessment of what the bond market is signaling about what comes next?
Well, I'm not sure I would look at the bond market for signals, because I think I'm a little bit confused by some of the market pricing out there. But my assessment would be that it really depends on where you're looking. If you're looking in Europe, if you're looking at the UK and the euro area, I think that a weaker real economy is going to do a lot of the heavy lifting in terms of containing the inflation problem from this shock. And so I don't expect to see a repeat of what we saw in 2022, which was eye-watering inflation. But the real economy, actually a lot more resilient than would have been expected. But I would contrast that with the US, where, yes, labor markets are definitely easing. You can see that in some of the vacancy unemployment ratio. But generally speaking, the US economy continues to be pretty resilient, and inflationary pressure, even before this crisis hit, was building for a range of different reasons. And so if you layer on top an additional very large price level shock in terms of higher energy prices, I think there you're going to see the impact popping up a lot more in inflation, and the real economy, I think, is more likely to stay resilient. So a different picture depending on where you're looking.
And that's really interesting, Catherine. And yet traders are pricing in rate cuts still for the Fed, and yet rate hikes for the ECB.
Therein lies the puzzle. I mean, to be clear, my call is also for some marginal rises in ECB rates. I actually don't think that they're going to need to do very much to be able to signal, credibility and competence and, keeping a lid on this inflation problem. I think they have done extremely well in the last couple of weeks and months, just setting out their position and making it really clear what's their reaction function. So my expectation is there's going to be a lot more certainty and stability, despite the uncertainty of the situation, about how the ECB is going to react, whereas we don't have that kind of certainty when it comes, for example, to the UK, or even less, I would argue, in the US. We don't know who's going to be the chair of the FOMC. We don't understand the dynamics, how that's going to work. There's obviously going to be differential views in the FOMC. That's natural. The macro signals are going in different directions. It's just very difficult to know where is the path for rates in the US. So again, from that perspective, I think I would have expected to see that difference, but that's not really what we're seeing in the market reaction so far. To your point.
Yeah. Well, Catherine, staying on the Fed, after listening to Kevin Warsh's testimony yesterday, are you more or less convinced about Fed independence?
So I take Warsh at his word that he's very committed to central bank independence. He came to the UK and did a review of the Bank of England. I think he is very committed to the role of these public institutions. My big takeaway from, and I mean, this was, definitely just my judgment, looking at it, different people will come to a different view, is that, maybe he could do a bit on rates, maybe he could do a bit on the balance sheet, but maybe the more important thing to watch is around reforms to the Fed, and what form that could look like. Both reforms in terms of just how the Fed itself functions, but also how it coordinates with other branches of government like the Treasury. That to me seems more impactful, more important, and certainly would have implications beyond, the immediate future.
Smaller balance sheet, do you think that's possible?
I think it is possible. It's probably, not going to be a whole heck of a lot smaller than where it is now. But some adjustments, I think, lower are definitely, feasible. I mean, even if you ask, the policymakers now who are looking at this, they never give you a number. Nobody really knows, where is the line, where is the inflection point where you could start to see stresses. And I think, the assessment is, let's stay miles away from that.
Okay.
But that suggests that there is a lot of, room for maneuver, and that it is possible to bring it a little bit lower. And there are sort of economic efficiency points that you can gain from having it lower. And that I think is the view that he has.
Catherine, we've run short of time. We really appreciate your insights this morning. Catherine Nice, Chief European Economist at PGIM Fixed Income. Coming up, we're going to speak to the CEO of Akzo Nobel. Stay with us. This is Bloomberg.
30 minutes to go until the start of cash trading here in Europe. European futures pointing modestly higher, 0.2% to the upside. The FTSE 100 may be something of a laggard as we watch what happens with oil prices. What I think is interesting is that Nasdaq futures are up by 0.7%. S&P E-mini futures are up by 0.6%. So you're getting a stronger showing stateside this morning in terms of the outlook when it comes to equities.
Yeah, arguably more conviction when it comes to the dollar move as well. The Bloomberg dollar index down 0.2%. But as you're saying, oil prices are down this morning on the back of the geopolitics out of the Middle East. And we are therefore seeing a bit of a modest bid, a bit of a cautionary bid for bonds as well, guys. So you're seeing yields broadly lower across US Treasuries. Wait for gilts to reopen, of course, at 8 a.m. UK time. But across European sovereign debt, you're seeing a little bit of a move into the sovereign debt, of course, of Italy. BTPs, yields down 3 basis points on the 10-year there. Over in France, Oats seeing some money moving in as well. Yields down between 1 to 2 basis points. So that is the picture broadly across the bond markets. A little bit of easing in terms of yields lower, price up on sovereign debt in the Eurozone. Let's get to the corporate story right now and earnings, with the impact, of course, in the Middle East filtering through. Akzo Nobel announcing price increases to fully offset the impact from the Middle East conflict. The Dutch paints and coatings company maintained its full-year guidance of at least 1.47 billion euros adjusted EBITDA. I'm very pleased to say we're joined now by the CEO of the company, Greg Poux-Guillaume. Greg, good morning. Thank you for your time. What gives you the confidence to maintain the guidance in an environment of deep uncertainty and supply chain ruptures in the Middle East?
To start off, we had a very good Q1. We delivered 7% above consensus in terms of EBITDA. We beat on pretty much all the metrics. So good start to the year. And in terms of the Middle East conflict, we have some fairly conservative assumptions in terms of how our raw material basket is going to be impacted, essentially in the high teens. And we have already announced and discussed with our customers corresponding price increases to mitigate that full impact. So we feel that we're in good shape as we move into the second part of the year.
In terms of the raw material input for the Akzo business, where is the key pain point right now in terms of materials that are seeing price hikes or scarcity?
It's really interesting because a lot of observers think it's about oil, but it's actually more about the disruption of the chemical value chain than it is about oil. If you look at things like NAFTA, I think 30 or 40% of the world's NAFTA comes from within the Gulf. If you look at, and NAFTA is a component of things like epoxy resins. If you look at something like sulfur, where 30 or 40% of the world's sulfur comes from inside the Strait of Hormuz, sulfur is a component of TiO2, which is the pigment for paint. So there's quite a few things that are impacted, but at this point, it's more of a price issue than it is a supply issue. And once again, we're mitigating this price impact by passing on the impact to our customers.
Okay. This feels like the 21-22 playbook when you push prices up quite strongly into a market that was seeing strong demand. Gregory, are we in the same place as we were then? We were just talking to an economist about this. Back then, there was strong demand. Is there the demand to price on, to push on these price rises to consumers? Are consumers going to be willing to take them?
Well, we're doing this in a softer market. So clearly, it's not the same market as environment as in 21-22. But actually, we're not seeing at this point an impact on demand. We are keeping a close eye on it because if we see this conflict continuing for much longer and we stay in a world of higher inflation, then over time that does have an impact. But at this point, we're not seeing a whole lot of pre-buying, for example, in Q1. So we think our customers also have a view that there's a potential resolution over time, and this might be something that we carry for the full year, but not necessarily beyond.
Is there not a risk that what they're actually seeing is the risk of demand destruction, that they're worried about the economic outlook and therefore they're not pre-buying?
No, there hasn't been an inflection in terms of consumption. We're a really interesting company because we're 65% B2B and 35% B2C. So we're seeing not only the DECO customers, customer confidence locally, but we're also seeing the B2B aspect of it. And in both sides of the business, we had a slow January, February, and we had a really good March, and April is also looking pretty good. So I would struggle to reach the same conclusion as you.
Greg, do you have internal models factoring in how long the Strait of Hormuz could remain closed? 1 month, 3 months, 6 months? What is a kind of worst case scenario? When does it become less about price and more about actually access to these raw materials?
I mean, that's a fair point. Over time, right now it's a price issue. Over time, it could be an access issue. In terms of assumptions, we've disclosed our assumptions. Actually, we're assuming Brent at 110 for the rest of the year. So we're making sure that we have assumptions that will not leave us short in terms of our discussions on mitigation through price.
Gregory, you also have a fairly diverse geographical footprint. Are you seeing different markets reacting differently? Does America look different to Europe, to Asia? How would you break it down geographically?
Well, currently, Europe and the U.S. are rather soft. And if you look at Q1, Asia and Latin America did really well. So it's a little bit counterintuitive because some of those raw material impacts, you expect them to be more impactful in Asia than, for example, in the U.S. But the U.S. was already in a softer market, and Asia's continued to do well.
Greg, are you looking at any other efficiency measures within the business to mitigate some of this impact, whether it's cost savings or job cuts? Are you comfortable with headcount at this level?
No, we are. We're not looking at additional measures. We already have a fairly aggressive plan in terms of cost efficiency. It was a 3-year plan, which is concluding at the end of this year. We are more than on track. Actually, we're ahead of schedule and ahead of targets, and we'll complete that plan this year. What we don't want to do is to compensate for raw material impacts by structural measures. The structural measures are meant to deliver performance improvement, not to mitigate a raw material variation.
Greg, final quick question from me. I'm just kind of trying to break it down and kind of find out where the strength and the weakness potentially is in terms of the demand picture. Any industry? What are you seeing from an industrial point of view? Is the car sector, what's happening in the car sector right now? What are you seeing in terms of what you're seeing in terms of maritime? Just can you give me a sense of whether or not it is kind of the demand picture looks even right now, whether or not you're seeing pockets of strength, pockets of weakness? You've given us some surprising geographical breakdowns. What's happening in terms of the industrial breakdown?
Well, let's see. Automotive is down. Automotive is struggling in general. Vehicle refinish, which is linked to people driving their car and dinging their car, has been depressed for about a year and a half. It mostly has to do with insurance premiums and purchasing power. It is resorbing and it's stabilizing, but we were expecting a pickup by the middle of the year, and right now we're seeing is a stabilization. If I take powder coatings, the architectural business, which is the powder coating for things like doors and frames and windows for construction, is actually picking up. The marine protective business, protective is things like it's for construction, fire protection and the likes, data centers. That's doing well. Marine is a bit has slowed down a little bit. Some of it has to do with the fact that marine is driven in part by dry dockings, and if you have 1,000 ships waiting to cross the Strait of Hormuz, they're not dry docking to get repainted. What am I missing in my overall picture? Packaging is okay, which is things like cans for beverages and food. And then if I look at the deco business, we had a good quarter in Q1. Latin America, Asia did really well, and Europe actually picked up speed in March and now in April.
Thanks for painting such a comprehensive picture. To excuse the pun, you're actually a really useful tell on what's happening with the global economy. Really interesting to hear what the business is doing right now. Gregory Guillaume, the CEO of Akzo Nobel. Thank you, sir. Coming up, Kevin Warsh gets a grilling from senators as he seeks confirmation as Fed chair.
Are you going to be the president's human sock puppet?
Senator, absolutely not.
Are you going to be anybody's human sock puppet?
No, I'm honored the president nominated me for the position, and I'll be an independent actor if confirmed as chairman of the Federal Reserve.
We're going to take a closer look at those hearings. The next Fed chair potentially on deck yesterday. We'll talk more about it in a moment. This is Bloomberg.
The Fed missed its mark, and we are still dealing with the legacy of the policy errors in 2021 and 2022. That means a regime change in the conduct of policy. I think that means a different new inflation framework. Presidents want lower rates, but Fed independence is up to the Fed. Independence has to be earned. And it's earned by delivering on the promises, the commitments that the Fed has made. The president never asked me to predetermine, commit, fix, decide on any interest rate decision. No, I'm honored the president nominated me for the position, and I'll be an independent actor if confirmed as chairman of the Federal Reserve.
Kevin Warsh on Capitol Hill yesterday. So President Trump's showdown with Republican Senator Thom Tillis leaves Warsh's candidacy in a state of uncertainty and the fate of the Fed's leadership unclear. Jay Powell meant to step down, of course, in May. Tillis has signalled he is open to advancing Warsh's nomination if an ongoing criminal inquiry into the central bank is dropped and Congress launches its own investigation. Something of an off-ramp then, potentially. Let's bring in Bloomberg's Balash Pence with the details. What do we know about this potential off-ramp? Is the president on board? Where do things stand in terms of getting Warsh into that seat?
Well, Thom Tillis did offer an off-ramp, as you said, Tom. He even framed it as such. He called it an off-ramp. But it is up to the president to take it. And Donald Trump, just a few hours before Kevin Warsh's testimony, doubled down and said it's important to see through the DOJ investigation. So it doesn't look like he's budging. It doesn't look like he's willing to take that off-ramp. And that's a problem because Thom Tillis remains that important swing vote to get the nomination out of committee and onto the Senate floor with less than a month remaining in Jay Powell's term. And without his support, that will not be happening. We will continue to see this impasse. So it does look like President Trump will need to decide whether he wants to focus on the investigation or whether he wants to get the nomination through as quickly as possible.
So is the next Fed chair to replace Jay Powell going to be Jay Powell? I know he won't be chair, but he will be effective chair. Is that what we're looking at here?
That is possible, Guy. Paradoxically, it looks like the longer President Trump keeps up the investigation into Jay Powell, the longer he might continue to serve as the leader of the Fed. After his term as the Fed chair ends in May, he will continue on the Fed until 2028. And in that capacity, he can continue to lead the central bank until such time as there's a new Fed chair confirmed. And let's just be clear, nobody, even Thom Tillis, says that they have a problem with Kevin Warsh's qualifications or his policy proposals. The only thing keeping him from being confirmed is this investigation that the DOJ is pursuing. But unless the DOJ drops it, it is very possible that Jay Powell will remain in the Fed leadership position.
Balash, great stuff. It's interesting to see what's going to happen next, which is the most important thing for President Trump, the investigation or Kevin Warsh as Fed chair. We're about to find out. Balash Pence updating us on that. Let's talk about the markets and kind of where we are. We are 12 minutes away, 13 minutes away from the start of cash equity trading here in Europe. Let's get 3 minutes with Paul Dobson now, Bloomberg's executive editor for Asia markets. Paul, we have a ceasefire extension, but still a closed Strait of Hormuz. How do I price that in to global markets?
With difficulty, Guy. Good morning. But what we are seeing, and I think increasingly so, is signs that the market is very minded to take an optimistic, a glass half full perspective on things here. So, yes, we had a little bit of a setback at the end of the US day with the idea that we're not seeing J.D. Vance flying to Pakistan just yet. Then Trump came out and said that the ceasefire will be extended indefinitely. And the market is taking that not as some sort of sign that the US is softening, but more as a sign that it's waiting patiently for Iran to sort itself out, and that actually in Iran there's some sort of disagreement, which Trump alluded to, between more moderate and more hardline elements. The market is holding on to the hope that the sort of more moderate approach will win out and that we'll be able to get to some sort of an agreement. And so you still see that with stocks hanging on in there and crude oil prices holding with, Brent somewhere just around but below $100 a barrel as well.
Paul, there is this disconnect between the equity rally and what's happening on the inflation front. We got a reminder of that with the CPI out of the UK that came in slightly stickier, slightly higher than the forecasts. We were speaking to the CEO of Akzo Nobel, talking about pushing up prices. That's going to go through and feed through to their consumers. When does that gap close? When do the equity markets wake up to the inflation challenge, or are they right to look through it at this stage?
I think that there's two things. One, you're absolutely right to point out the real-world impacts are growing from the crisis pretty much every day. At the moment, Tom, we're not just seeing that in inflation readings, but we're seeing it in larger and larger companies talking about impacts to their production, talking about, cancelling flights if it's airline companies as well, and talking about the need to raise prices. So it is feeding now into the real economy. The market is looking through that and looking more to the optimism on the sort of tech side in particular, than it is sort of still seeing it as, they whisper the word transitory. Well, we've heard that from central bankers, of course, before, and it proved to be a lot longer and stickier than they had hoped for. The market is still looking on the bright side of things. But at some point, if we don't get a resolution and we don't get oil starting to flow through the markets again, then there will be a wake-up moment for the market.
What did you make of the Warsh hearings, Paul?
Yeah, interesting one, wasn't it? I mean, the biggest takeaway was probably the soundbite from Elizabeth Warren talking about accusing him of being a sock puppet, and the fact that, he had to sort of write that out and deny it. I feel like Bloomberg Intelligence's analysis is quite an interesting one to think about here. They sort of see him more as a little bit on the hawkish side, talking about the needs to manage inflation in the economy. Talking a little bit less about the mandate on the employment side, and so they're thinking about it through that sort of a lens. What I would say more broadly, though, is that the Treasury market is getting increasingly unruffled, not only with the Warsh comments, but also with the war in the Middle East too. We're seeing implied volatility on that really falling down, and the yield range that we're seeing in the Treasuries market also slide. That's helping credit outperform and also boosting those equities.
Paul Dobson, Bloomberg's executive editor for Asia Markets. Paul, thank you. Let's get your stocks to watch this Wednesday and bring Chloe Melly. Chloe, what are you looking at?
Good morning, Tom. Let's start with some M&A this morning. So Deutsche Telekom is said to be considering a full combination with its American arm T-Mobile. So this would create a massive multinational telecom company and would actually also rank as the largest ever public M&A deal. So we should watch out for any kind of movement there. There are some challenges. So Bloomberg Intelligence analysts have noted there were potentially issues with limited synergies and regulatory hurdles, among other problems. So it might not be that smooth of a process getting there, so we'll be watching out for any developments with this M&A deal. Moving on to ASM, which could be moving higher today after a second quarter guidance beat estimates. So this really shows the continued demand, resilient demand for chip making equipment because of those billions and billions of dollars getting poured into the build out of AI data centers. And this really follows in the footsteps of what we saw from ASML earlier in the season and shows the strength across that sector. So we've already seen ASM shares hit those record highs, and that could be extended further. And finally, there is some more pain to come for the airline industry. Lufthansa has said that it will cut 20,000 flights from its summer schedule to save on fuel costs. This is the latest airline to take some drastic steps to deal with those higher fuel costs. We had Alaska Air, for example, suspending its guidance, United also cutting its outlook. And for Lufthansa, there is this issue of higher fuel costs, but then also it is dealing with labor action. And so we have seen the shares, as we can see here, going up and down quite a bit over the last month, but today it might be more of a downward move for Lufthansa.
Chloe Melly, thank you very much indeed. Yeah, we'll look at travel and leisure, that sector, again today on those updates out of the airline sector. We're also going to be watching some of the companies that supply into the data center space. ABB has actually raised its expectations, its forecast for the year, given the demand in terms of electrification tied to the data center build-out. So again, supporting that narrative that the demand is still there as that infrastructure is built out. And then you do have European players that are benefiting on the back of this. There could be a read across from the likes of Schneider Electric, Siemens, who also play in a similar space.
It's interesting, isn't it? You're seeing initially, there has been a big focus on the chips recently, but initially it was kind of companies like Nvidia. That was where the kind of they got priced in. Then we moved on to the kind of the chip pricing story and what was happening there. And we're firmly now into the we don't have enough electrons trade, and that is the biggest problem that we face. So Asia Brand Bavaria is going to benefit, as you say. There's plenty of other European names. So talking about Europe not having a sort of part of the tech trade, slightly erroneous. Quite a big part of the re-electrification trade or the electrification trade.
Yeah, is that being overlooked?
Yeah.
And to your point on the chip story, we've got a great piece on the Bloomberg terminal today, just pointing out, despite the rallies that we've seen in the likes of some of those memory chip providers like SK Hynix and Samsung and Micron over in the US, the valuations are actually looking pretty attractive versus the Nvidias of the world, or indeed the TSMCs on the foundry.
We were debating this yesterday, but are they cyclical? This is the question. Or are they in a super cycle? Can they avoid the cyclicality that normally faces them? Let's talk about what's happening here in London or not happening here in London.
Cycles.
Nice. Tube strike. We got a sort of on-off tube strike this week, and that obviously is affecting people's ability to get to work. So I suspect, given the weather, we're going to see more people walking to work. I think you saw a little bit of this yesterday, though the strike hadn't started, but there was a pickup yesterday. A lot of bicycles, I suspect, on the London roads.
Cab drivers probably doing quite well. Uber drivers probably doing quite well. Fitness levels maybe picking up. There's a couple of cyclists on there. It's a beautiful day. This week's going to be just sunshine, glorious throughout this week. 20 degrees on Saturday, so we can embrace that.
So if you're going to pick a tube strike, the time to have a tube strike, this probably is. The weather kind of
mitigate some of the pain.
Yes, it was going to be raining hard out there. Different story.
Coming up, it is the start, of course, of trading this Wednesday. European futures right now, after 2 days of losses, pointing very modestly higher, a little shy of 0.2%. It's a slightly brighter picture when it comes to US futures. S&P E-mini is pointing higher by 0.6%. Oil is lower, down 0.8% on Brent at $97 a barrel. Dave and Trade up next. This is Bloomberg.
Couple of minutes to go, and then we start cash equity trading here in Europe. Let's deal with some context, then give you an idea of where we're going to open this morning. This was the session yesterday over in the United States, the US session, an initial jump this initial position here faded quite quickly towards the end of the session as the geopolitics maybe started to look a little bit rockier. We didn't know whether Vice President Vance was going to be going to Islamabad. It turns out he didn't go, and that's kind of the narrative that we priced in throughout the session. You did have some corporate results as well, which probably also fed that narrative as well. Look at United Airlines, look at what we had out from Alaska as well, withdrawing guidance. So that was the picture over the United States. How does that translate into the picture here this morning? At the moment, US futures are actually more positive than European futures, so that's interesting in itself on the idea that we are going to see the ceasefire being extended. Europe is up by 0.2% on the Stocks 50. FTSE's down a little bit. That's oil prices. DAX is up a little bit, but we're not seeing much movement initially in Europe, Tom.
We are starting to see the impact on the corporates as we've been discussing through this show, guys. So some of the individual stocks that we're focusing in on, the basket stocks around airlines. You've had the update from Lufthansa looking to cut 20,000 uneconomic routes over the summer period, hoping to save about 40,000 tons of jet fuel. On the deals front, Deutsche Telekom, interestingly, and this has been in the play for a number of years, but looking to take over T-Mobile, considering a full combination with its American arm T-Mobile, which is the biggest revenue driver for the business. So we're watching Deutsche Telekom in the session as well. And chip stocks, once again, the semis trade continues at pace, and we saw that again in the Asian session. So we watch those sectors and individual names, Guy.
Keep an eye on the electrification trade as well this morning. That's another factor we're going to watch into this market open, which is almost upon us. Here we go. Let me show you some numbers. We are expecting maybe a little turbulence in some of the oil names. FTSE 100 is not expected to go. In fact, European markets are not expected to go anywhere in a hurry this morning. FTSE 100 is up less than 0.1%. That's a little better than anticipated. We've had CPI out of the UK as well this morning. We'll get the gilts trade in just a moment. Stock 600 is up by 0.2%. Keep an eye on what happens with ABB out of Switzerland this morning. That could be an interesting trade. That could ripple through into names like Schneider, etc. in the French market. That will be a factor to watch. The DAX clearly has no news this morning. It's open. It's up by 0.4% and is outperforming this morning. We'll watch to see what Akzo Nobel does this morning on the back of its numbers as well. It's talking about price rises offsetting maybe the effect coming through from the Middle East. CAC still not open. AEX still not open. We'll see how some of the chip stocks trade this morning. But Tom, at the moment, a reasonably muted start, slightly positive, but muted start to the European trading session.
As we break down sector by sector, you're seeing basic resources currently at the top of the list. We've seen stronger silver prices and gold prices in the session today, so that's lifting that sector. Basic resources with gains of a little over 1%. Industrials are in the mix as well on the upside, up 0.8%. Tech, we talked about the semiconductor space and the fact that that trade continues. Tech up 0.4%. The electrification story as well in industrials and defence. Banks gaining 0.5% on the downside. Biggest losses coming through. Not surprisingly, this is an area we've been zeroing in on this morning, is travel and leisure, with the airline adjustments around the fuel price costs, and Finnish Air, for example, coming out and warning about the impact of higher fuel costs. So travel and leisure, the biggest loser across your sectors, down 0.5%, followed by media, consumer and health, all down between 0.3% and 0.4%. Health just down 0.2%. But the biggest losses, again, travel and leisure on the downside, down 0.6%. The biggest gains coming through for basic resources, up a little over 1%, Guy.
Akzo's up quite strongly on the back of it passing through price rises, up by 4.5% on the back of this. The stock has been hit since the start of the conflict, so a little bit of better news maybe coming through in the paint sector. Coatings sector. Schneider Electric is also higher, so we're maybe seeing a ripple effect coming through from ABB into some of the other electrification names. It's up by 3.1% this morning. On the downside, it's an interesting little mix in terms of where we're seeing the heavyweights. There's a few XDs. I think DNB's XD this morning, so just bear that in mind. But some of the airline stocks certainly are coming off a little bit in terms of what we're seeing. So I think I just saw Lufthansa down a little bit, but we'll come back to that in just a moment. Let me see if I can get that one up. So, no, that's Deutsche Telekom, actually. Wrong Deutsche. So we're seeing that stock potentially under a little bit of pressure as well on the M&A news that we're talking about with T-Mobile. Yeah,
and we'll see if they can get that across the line. Some scrutiny, no doubt, on the US side and the European side as to whether or not that can go through. Let's bring in Patrick Brenner, who's joining us around set right now, multi-asset CIO at Schroders. Patrick, good morning. You remain and maintain an overweight on equities. At what point does the closure of the Strait of Hormuz, what kind of time frame would derail that overweight view on stocks? As we look at what seems to be this disconnect between the equity rally and the inflation story.
Yeah, I think, look, we started the year positive equity, really on the view that earnings will deliver and will continue to drive equity higher. And fact is, we haven't changed that view.
A lot has changed since the start of the year. A lot has changed,
and we come to that. But I think when it comes to earnings, and when you look at the fundamentals, things haven't changed, right? Earnings have continued to deliver very strongly. They've been not only resilient, they've been remarkably strong. And I think this is really what we say at the beginning of the year, which is this is going to drive the market higher. And so far, we're sticking to that view that as long as the earnings are strong, we see no reason why equities should slow down.
Is that a this quarter story, though? As we look out to future quarters, given the margin squeeze that could be coming through, does that narrative start to erode the longer this Strait of Hormuz closure continues? Is that the risk?
I mean, it is clearly a risk, and I think we were talking about what has changed, and I think what has changed is probably at the beginning of the year when we were looking at risk scenarios, all the risk scenarios were skewed more towards the inflationary risk. Today, we have to acknowledge that with the disruption in the Middle East, the risk between inflation and growth are more balanced. So I think clearly we have to acknowledge that. So it's a question of time. If we sit here again in 6 months' time and oil is still at 150, then probably our baseline view is going to be challenged. But for now, earnings are being delivered. We're seeing actually upgrades in earnings expectations. So we think still strong fundamentals which support the idea of a strong equity market.
Is that earnings story only limited, though, to what we're seeing in tech?
So there is no hiding from the fact that clearly the earnings story has been narrow, right? You're right, tech has been driven by tech, has been also driven by energy. But by itself, this is nothing really new, right? We've been in this environment for a long time. So we have to accept that part of the market, a narrow part of the market, is driving the market. It doesn't mean it's bad by itself. I think the second point is, if you look outside of tech and energy, the rest of the sector, yes, we haven't seen upgrades, but we haven't seen downgrade neither, which I think is quite remarkable in such an environment. So I think it shows that the underlying data, the underlying economy are quite in a good shape.
Analysts don't tend to change their outlooks until they have enough information to do so and have stability of the information they're inputting to make those changes. Is that what we're just seeing here? There's too much volatility for analysts to change their guidance?
I mean, I'm not sure. If you look at Liberation Day, for example, you saw earnings downgrades, during Liberation Day because investors or analysts were worried about tariff. If you look at soft data like CIO Confidence Index, we saw a big drop during Liberation Day. This time around, we haven't seen CIO really raising big concern. I'm not sure exactly what's the reason. We should ask
them. But they got it wrong last time. That was the problem. And is the problem this time that they're not going to make the changes because changes were made last time and they turned out to be erroneous?
Yeah, but I mean, if you're a CIO, you need to manage expectation as well, right? Yeah. So I think I would say rather that potentially they've learned from the fact that actually, number one, the economy has the ability to adjust massively to external shocks. Yeah. Maybe CIO are more used to energy shocks than tariff shocks. That might be a reason.
Do you adjust the portfolio around the regional vulnerability to that energy shock? As in, do you lean into the US, then Europe, then Asia? How do you think about the regional spread that should be factored into a portfolio?
Yeah, so I think there's been a couple of changes we've done in the portfolio. So with the conflicts in the Middle East, when we look at the economic impact, we actually end up finding that probably the US is more immune than the rest of the world, both in terms of inflation and growth impact. The part of the world which is the most impacted, we think, are Asia and Europe. So this is probably the two regions where we'll be a bit more careful. The other changes in terms of asset allocation mix, what we've done, the term of change that we've done recently, is that we've taken profit on our commodity positive view, because we think that the energy market has become very binary. And because we want to express a more balanced view between inflation and growth risk, we've also closed our short duration view. And so we think that being long equity but neutral duration reflect better this idea of balance of risk between growth and inflation.
And you've added the UK and Canada.
So that's a good point. On the equity side, we like actually a barbell strategy. So on one hand of the barbell, we like the US market, the tech market, which is delivering in terms of earnings. But on the other side, we want complementarity. So we're looking for UK and actually Canadian equity, which are more sensitive to the energy-related stocks, but also have a more cyclical aspect. So we believe that having those two sides of the barbell brings a lot of complementarity in the portfolios.
Do you think it's reasonable that the Fed cuts rates, which is priced at the moment, and the ECB raises rates?
I mean, this is possible, but the current pricing seems quite excessive to us. So we will rather expect some kind of conversion between the ECB and the Fed. And that's why when it comes to the fixed income side, we have a preference for European duration rather than US duration. So while we're neutral overall on duration, we express a preference for European over US duration.
If the ECB does, if the ECB does hike rates, is there a danger that the ECB decides that actually it has an inflation mandate and not a growth mandate, and as a result of which it makes the European picture worse, that the growth picture in Europe is where the real risk lies right now from a market perspective, and that would be exacerbated if we do see action by the ECB?
I think that's clearly a risk, and that's why we think that the balance of risk now are more balanced between inflation and growth risk, because effectively if the ECB or other central bank hike aggressively, this will start to have an impact on growth. We're not in a situation where we think the economy can really digest massive hike from central bank, especially in Europe.
Is gold still a good hedge?
So I think we have to be careful here. We still like gold strategically in the portfolio, but we've said very clearly we don't see gold as a geopolitical hedge. We've seen clearly increasing correlation between gold and equity in March during the sell-off. So I think,
is it a dollar debasement story?
Exactly. I think the story around gold is you have to believe in the continuation of the dollar debasement, and to some extent some question mark around the sustainability of debt level across the M market.
how much every day, and we'll do it later on, we'd see equity markets bouncing around all over the place, but the volume numbers underneath it are not being supported. What are you seeing in terms of the internals? How much are you trading? What are you doing right now? Are institutions just sitting this one out? Is it CTAs and hedge funds that are chasing this market? What do you see happening below the surface? And how does that affect what you're doing?
So on our side, we're really trying hard to avoid trading the daily headlines. We are, in general, trying to avoid overtrading. And really try to stick to the fundamentals. So, this is where we think we have a hedge, and we are trying to avoid overtrading in an environment where headlines can move not from one day to the other, but from 1 hour to the other.
You said it's hard. Is it hard to
It is hard because, we are human, we're emotional, and when the market goes against you, it's hard to stick to your guns. But I think it is important in those difficult times not to panic, to stick to what you think you're good at and stick to the fundamentals in our cases.
Great to see you, Patrick. Thanks for stopping by to see us. We really appreciate it. Patrick Brenner, multi-asset CIO, joining us from Schroders. Quick look at how the market is trading this morning. Let's give you some individual names. Start off with kind of the centre of gravity. Defence stocks are down, luxury is down, chips are definitely having a good day. ASML is up, ASMI is up. You're also seeing a big trade into ABB. Let's start with that chip trade, though. Chloe has more details on that.
Good morning, Guy. Indeed, ASM is, as expected, doing very well this morning. We're up almost 9% after second quarter guidance beat estimates. So this really underscores this continued resilient demand for chip-making equipment because of all of these big tech names investing so much in AI and pouring billions of dollars into the data center build-out. And so this is a really bright outlook for ASM, and we are up very strongly this morning. Another sector that is benefiting from this AI data center build-out is the electrification and data center equipment sector, including the likes of ABB, which this morning raises revenue expectations because of a surge in orders from data center customers. And so we are seeing that really drive the shares this morning and have that read across for the entire sector, with Siemens, Schneider Electric and Legrand also in the green this morning. Moving on to Akzo Nobel, and the company, the paint maker, is also up actually quite strongly, up 5%. Its results beat expectations, and it said that it was also able to pass on the rising costs associated with the war in the Middle East to customers by hiking prices. And so this is seen as quite reassuring, and we are up quite strongly this morning. And finally, let's end with a downward move for Reckitt, which is down almost 6% after saying that it had weaker sales for its cold medicines in the US, and the war in the Middle East had also disrupted supplies in the region. So a less positive morning for Reckitt.
Chloe, thank you very much indeed. With the stocks on the move this morning, Chloe Melee. Coming up, German carrier Deutsche Telekom said to be weighing a full combination with its American arm T-Mobile. We'll bring you the details on what could be the largest ever public M&A deal. That's next. This is Bloomberg. Welcome back to the opening trade. We are 16 minutes into today's session. Across the benchmark in Europe, you're seeing gains, modest gains of 0.2%. It's been a bit of a choppy session. US futures are slightly brighter in terms of the picture they are painting. S&P E-mini is pointing to gains of 0.6%. The earnings story, there's been some optimism, there's been some positivity, particularly when it comes to companies in the tech space, and Europe is exposed and is benefiting as a result of that. One name is ASM International. Shares up almost 9% right now, hitting a record high this morning after the semi-equipment company reported first quarter revenue that beat estimates and projected sales for the second quarter that also exceeded analysts' expectations. Joining us is Matt Bloxham, senior analyst at Bloomberg Intelligence. What were the key takeaways from you for ASM? It seems to position them in a pretty robust place, right, as they look to the next quarter with this demand story.
So ASM a manufacturer of the equipment that chip companies make to produce the chips, and kind of very much driven by that AI story, which continues to have really strong momentum. That's coming through both in the first quarter numbers, which a few percent ahead of expectations, but then this kind of second quarter earnings revenue guidance significantly above market expectations, maybe about a 10% beat. And I think analysts now kind of projecting that forward into to a much stronger full year and upgraded profit expectations. So I think, this kind of talks the story that, the likes of ASM and ASML that are kind of producing the equipment that the likes of TSMC use to make the chips. It's a really strong place to be in the kind of value chain, and particularly as companies move to kind of ever more advanced chips with a lower number of nanometers, then actually these companies are really well positioned to deliver that product. So I think that we always have these questions about the AI bubble and whether it's kind of going to burst or anything. But I think right now this clearly demonstrates that there's still very strong demand for AI chips.
Stock's up 60% plus since the beginning of the year. Do I need to be concerned that Mythos is out there in the wild, that others have got it?
I think we probably do need to be a little bit concerned, I mean, obviously Mythos is this latest AI model from Anthropic, who have said themselves that it's incredibly good at cyber.
We're finding
cyber
gaps
threats.
in
Exactly,
yeah.
And so, obviously right now it's been very controlled in the release. Anthropic has given it to a small number of high-end software companies like Apple so that they can test it on their systems for vulnerabilities, so that when it does get formally released to the public, that any obvious kind of patches that need to be applied have been applied. Obviously, financial institutions are very concerned about this tool too, and they want to get their hands on it before it comes out live, so that they can test it. I think that so far this kind of leak of the tool of the platform to a small group of users on an online platform is worrying. They're not using it for malicious purposes right now, but if somebody were to decide to use it for malicious purposes at this point in time, given that none of these big institutions have been able to test it properly, it could create some systemic risk, I think.
Yeah, a lot of institutions, a lot of governments still clamouring to get access to Mythos. So we'll see how they fold that out as well and give that access. But it points to the demand that's there. But I mean, particularly for Anthropic's products, and that ties into the ASM story, doesn't it? Because you can't run these models without the equipment that's going in and without the chips. And on the chip side, I mean, something Guy and I were talking about yesterday on the show was the semiconductor strength that we're seeing, particularly when it comes to memory, NAND, RAN and HBM, high bandwidth memory. And that seems to be unabated. I mean, it's just like the upside continues. The stocks are performing very well. The valuations are looking pretty reasonable on many metrics. So I guess the quick question is do you think that we pass cyclical now for these, because of the AI demand for these kind of chips? Where do you land on this debate, whether this is a super cycle or whether that cyclicality comes back?
Personally, I'd still be reluctant to give up the memory of the cyclicality of the memory stocks. And I think, there's an interesting story, kind of showing this disparity between the relative valuations of the likes of Samsung, down on 6 times earnings, and TSMC and Nvidia are kind of up in the kind of 18 to 20 times. And I think to kind of drive a big re-rating of something like Samsung, you would need to fully believe in that kind of super cycle story, and I think that's contingent on a lot more kind of robustness in the durability of the AI demand boost that we're seeing now. And I think a lot of investors are going to be cautious to kind of really lean into that in a big way, because they've been burnt so many times before.
It's horribly cyclical. That's what history tells you. But the question is it the demand slows down, or is it actually these guys just produce so much of what is out there, of what is demanded out there, that actually they just flood the market, and that's what causes the cyclicality?
And we're at that point now where memory companies are investing in additional capacity, and you potentially get into that step function again where suddenly there's a big glut of capacity, and we're back. And I said, that there's lots more competition in the memory chip space than there is, say, in the TSMC space. So the likes of TSMC are justifying a bigger multiple because they have a much stronger position in their marketplace, and obviously the likes of Samsung, also in lots of other product marketplaces like particularly smartphones and displays, and so you have to kind of take that into account in the multiple too.
It's really interesting because a lot of the upgrades at the moment in terms of the earnings expectations are coming from this space. So if you believe in the cyclicality story,
that's a problem.
You've got to look at that and maybe raise an eyebrow. Okay. Matt, great to see you back here. Matt Bloxham, senior analyst at Bloomberg Intelligence, joining us on the telecom. No, not the telecom space, the technology. I'm going to do TMT now, which takes us back a while. We're going to go from technology to telecoms. DT, Deutsche Telekom share price. Let's take a look at what is happening here. Under a little bit of pressure, down by nearly 2%. Bloomberg understands that Deutsche Telekom is considering a full combination with its American arm, T-Mobile. Should we call it a recombination? I don't know. If approved, the deal would create a multinational telecom group and rank as the largest ever public M&A deal. For more, let's bring in Bloomberg Deals reporter Manuel Bagori. Why would DT do this? What is the upside for Deutsche Telekom?
Well, clearly, consolidation in the telecom space has been ongoing for years, decades actually, and the companies have realized and advocated that they need to consolidate to be able to keep up with investments and to be able to provide services as well for customers. Now, they face a lot of regulatory hurdles, obstacles to overcome, and political backlash as well. Here we are again on another iteration of Deutsche Telekom, which already owns more than 53% in fact, of T-Mobile US, trying to come up with a new proposal to combine the two companies, as our sources reveal. The idea is just simply to create a more simple and potentially nimble structure that can leverage these two global companies and at the same time potentially create more synergies and have more leverage for further investments.
Manuel, you talked about potentially some of the obstacles to this deal getting across the line. What is the likelihood right now that Deutsche Telekom can pull this off?
It is a very complicated transaction, Tom. Definitely, commercially, it makes a lot of sense, and that's why they've been holding on and off and on again talks over the years to try to combine the two or come up with some sort of transaction. Now the problem is the German government owns stake in Deutsche Telekom, and obviously we're talking about two companies that are very sizable, very incumbent players in their own market, so to speak, and that obviously have a lot of impact on consumers, and also they hold critical and very sensitive data and technology. So obviously the political hurdles will be very steep and hard to overcome, but then there will be a lot of regulatory scrutiny on things like antitrust potentially as well, even if this being a cross-border deal should be less of a hurdle perhaps.
Well, great stuff. Thank you very much indeed for the update. Manuel Bagori joining us on the DT deal potentially over in the United States. We've talked earlier about what is happening in the airline sector, the travel sector, and we get more information on that now. Remember, we've seen Lufthansa cutting its capacity for the summer overnight. We've seen Alaska cutting its guidance. We've seen United Airlines reducing its guidance. Now we have another from Europe. TUI, the travel company, suspending its 2026 revenue guidance due to the uncertainty around the Iran war. It's suspending revenue guidance until conditions stabilize.
And travel and leisure as a sector is the biggest loser across your sectors right now, and that is part of the story, down 0.9%. Expect more on this front, you would expect. Coming up, we're going to talk macro. We're going to bring in Victoria Clark, UK chief economist at Santander, as of course the Middle East war sends UK inflation higher, at least on a month-by-month basis for the month of March. Her analysis is coming up. What does it mean for the BOE? That's next. This is Bloomberg. Welcome back. This is the opening trade. We are 30 minutes into today's session. You're seeing some very modest optimism in the European markets today after 2 days of losses, up 0.2%, presumably on the extension of this ceasefire. But the clarity about when the Strait of Hormuz opens remains zero. No certainty on that front at all. Some earnings stories coming through as well. Some on the upside, some on the downside. The forecast being cut for the travel and leisure sector. That's a bit of a drag. Across the German benchmark, you're seeing gains of 0.3%. So a solid day over in Germany. Flat on the CAC current over in France. A little bit weaker here in the UK. The FTSE 100 down 0.1%. of a percent. Guy, what are you seeing?
Okay, let's work our way through the numbers and get an idea of what's going on. Higher 333, lower 250. Reasonably balanced market this morning, but once again, I point you in the direction of what is happening with the volume numbers. This is not a market that is supported by big volume at the moment. Institutions appear to be trying to avoid trading the headlines. We heard about that earlier on in the show, and I think that is continuously evidenced by what we're seeing in terms of this data. Leaders and laggards, let's talk about the leaders first of all and get into what we are seeing. We're certainly seeing a big pickup in the chip space. Broadly, I would argue maybe the AI space. ASM International is up very strongly. Stocks up 60% plus since the beginning of the year on the back of what we're seeing in terms of chip demand. ASML is a beneficiary of that. We're seeing that feeding through, up by 1.52%. You've also got what we are seeing in terms of the coating sector. You're seeing Akzo Nobel doing quite well, as you are also seeing ABB, Asia Brown Boveri, the Swiss-Swedish engineering group, up by nearly 5% this morning. It's the electrification trade around what you're seeing around some of this AI trade that we're seeing elsewhere in the market this morning. So some connections on all the boards that we're looking at here. Reckitt's down by 6%. You are being punished in terms of what you are getting in terms of the numbers if you don't meet expectations. Essilor is down. Rolls-Royce is down by 2.56% as well. There's a bit of the airline sector in there. There's a bit of what you're seeing in terms of what we're getting around defence as well. But you're seeing names like TUI under pressure. The airline sector over the last 24 hours beginning to talk about the impact that it is seeing as a result of what we are seeing as a consequence of the lack of jet fuel that we're getting out there, Tom.
Okay, here's what else you need to know this morning. Of course, what is focusing on is the Middle East and what transpires in terms of any potential conversations between Iran and the US. President Trump saying he is extending the ceasefire with Iran indefinitely. The Strait of Hormuz remains closed to shipping, as we've been discussing, with Iran saying it won't reopen the vital waterway while the US maintains its own blockade. The president also made cryptic comments about China possibly providing weapons to Iran, a move that would test a US red line on aiding Tehran during the war. EU ambassadors, meanwhile, are set to discuss the release of a previously blocked €90 billion loan to Ukraine. President Volodymyr Zelensky says repairs have been completed on the Druzhba oil pipeline, allowing the resumption of Russian oil flows to Europe. That was a sticking point with Hungary's outgoing Prime Minister Viktor Orbán. EU top diplomat Kaja Kallas says she expects a positive decision on the loan in, quote, the next 24 hours. And Lufthansa is planning to cut 20,000 short-haul flights from its European summer schedule to save on jet fuel, which has doubled in price since the start of the Iran war. The cuts will amount to 1% of available seat kilometres and save around 40,000 tonnes of jet fuel. Lufthansa has taken some of the most drastic steps among global airlines since the conflict started, as it also contends with walkouts by pilots and cabin crew. Guy.
Tom, let's talk about what we're seeing in the UK right now. Front-end gilts down a little bit in terms of the yield that we are watching. You've got OIS pricing currently, I think, kind of around 40 basis points of hikes. That is the context with which we look at today's inflation data, accelerating in March as a surge in energy costs triggered by the Iran war started to come through and hit consumers. Consumer prices rose 3.3%. That's a headline number, up from 3% in the previous month. Critically, though, what you are seeing is elsewhere in the market, actually some stability. The core number certainly looks much more stable. So should we be excited by today's data? Is it telling us anything that we didn't already know and giving us clues as to where the Bank of England goes next? Victoria Clark, UK Chief Economist at Santander Corporate and Investment Bank, joins us now around the table. Exciting data?
I'm not excited by the data, no, but that I'm pleased about, actually.
Yep.
Actually, I mean, I think we would have some problems if we were starting to see more evidence of the war creeping into some things at this point. So almost all of the rise in the CPI today, it's the big jump in petrol and diesel prices, up 8.7% over the month. And then you've got a bit from airfares, that's more about Easter timing, and then a big jump in heating, all up 90%. This is all the stuff that we'd already seen, had sight of. I think on the goods inflation side, that's looking still pretty subdued. And there's still the same old services inflation, but that's not new news. That's the old news that we've been used to for a while.
So is the market overpricing rate hikes in the Bank of England?
I think it probably is. I think that at the moment, all we can see is that we've got this energy shock. And when I look at the labour market data, the release of yesterday, that tells me that the labour market is not strong. This is not a 2022 labour market. The wage dynamics are different. Employee bargaining power is much weaker on the private sector side. So you really shouldn't expect to see what is going to be an energy shock at first turn into something more permanent through wage increases. So I think at the moment the data that we have and the geopolitical situation is changing daily, but at the moment it tells me that this is more of an inflation shock that you could look through than the 2022 one. And our baseline actually is unchanged for this year in rates.
Does that suggest that 2026 is not a year of stagflation in the UK, but it is a year of weaker growth?
So I think we're going to get more inflation. For sure. I mean, obviously, that's the energy effect. I think that the labour market is struggling, and that's been struggling for a while for lots of other reasons, and this probably adds to that weakness. So if you like, there's that element. Now, the growth side, I think, is, that's been subdued. Then we had this good first quarter, which we typically do have, actually, in the UK, quirk of the UK statistics and other factors. And I think from here, I'm worried about growth going forward. It's, we've not seen the impact on the growth numbers yet. That's still to come. But, you don't get disruption like this across Europe, across airline fuel supply, the kind of sentiment impact as well, without some impact on growth. So I'm quite worried about the second half of the year.
OK, let's put a number on that. So as things stand, and with the BOE on hold, which is your forecast for this year, where does growth end up at this point?
So I've got the first quarter's grown strongly. The second quarter's a bit middling, and the third quarter down. So a contraction in the third quarter, and over the year in totality, you're going to end up probably around 0.5%. But that's a very up and down year. That 0.5% hides a whole variety of growth stories within it. And I think one of the things that's important to note is that for a while the private sector demand story. The private sector economy has been struggling, and fiscal policy, which is a whole different story, but that's obviously been helping drive demand.
It does make you wonder whether the Bank of England should be cutting rates at this point. Would that be a more realistic expectation maybe later this year?
So obviously at the moment it would be a very risky play because there's just much that they don't know, and the energy shock could get bigger, and that might make inflation move above, far above our baseline into a world where they do end up in this world.
But later this year?
But later this year, I mean, I certainly wouldn't rule it out, because if the demand shock gets big and it gets big quickly, you've got to really look through that energy shock. The risk of second round stuff, if you've got big demand destruction, is lower. So, I mean, it's something that we've been talking to people about more and more, but I think that in that demand destruction environment, definitely don't rule that out. Back end of the year, though, rather than the data
when we have more
watching
information.
Period. Exactly.
Do you think, you touched on fiscal, should markets be starting to think about more fiscal ambition from a government that's under pressure and a leader that's under pressure? Are they going to have to open the taps even as constrained as the UK is? Should we start to think that maybe there's going to be more of a fiscal impulse?
Fiscal could go one of two ways, right? At the moment, you've got rates higher, you've got inflation higher. That's eaten well into the headroom that the Chancellor had. If she takes the really tough line, actually what she should be doing is lifting taxes or cutting spending at the next budget, and that would all, squeeze the backdrop further. But of course, the world is changing, politics may change as well, and all of that might mean that you have a different fiscal stance. And it may be that that's additional defence spending. It obviously may mean that you want more support there to manage some of the crisis shocks that are there on households. I think economists will tell you be very wary about doing that, but you can see that might be appealing to the politicians.
If you raise taxes at this point in a growth slowdown environment, though, you've already seen the effect of, particularly on the corporate side, but increasingly elsewhere, of the effect of what that has done to growth.
Yeah.
Hasn't the household and corporate tolerance for tax hikes just reached a tipping point right now? How much further can you push it?
Do you get what happens?
Yeah.
What does the curve tell us about where we are in that kind of scenario?
I think tax increases are really difficult at this point. I do, because look, the IMF said it last week. The UK tax increases that are there and that are planned are very significant in the context of our peers. That's important. You know, the UK is trying to build credibility here,
Yep.
we're trying to get investment. I think that's challenging. The other place they can go if they want to stick to the fiscal rules that's laid out is, of course, on the spending side. And there is scope to do that, but that's much trickier for them to do, and there doesn't seem to be the will at the moment to do it. There's a lot of very difficult choices, which is what, you know, essentially what the gilt market's been saying the last few days is, you know, we've got this inflation problem, we've got this fiscal problem, you've got the politics thrown in. It's not very simple how you solve that in a way that gives you a determined view on fiscal sustainability in the UK.
Victoria, thank you very much indeed. Victoria Clark, UK Chief Economist at Santander Corporate and Investment Banking. Coming up, oil on the move over reports from Iran that the US is ready, or could be ready, to end its naval blockade. We're going to bring you the details and the latest. That is next. This is Bloomberg. Oil is a little weaker this morning after Iran's UN envoy said they had received, quote, some sign that the US is ready to end their naval blockade. This, according to Iran's semi-official Tasnim News. The report comes after President Trump said the US was going to maintain the blockade but will extend the ceasefire indefinitely. Let's bring in Stephen Stupczynski right now, who leads our Asia energy coverage. Stephen, get us up to speed on how traders are adjusting to the mixed messaging out of the Middle East.
You know, I think that of all the situations, worst case scenarios that they were planning for today, when today was supposed to end the ceasefire, this is one of the better scenarios, right? The ceasefire is indefinitely extended. The bad news, of course, is that Hormuz, a key conduit for about a fifth of global oil and seaborne gas trade, remains shut. And it's unclear when that will open again. Now, we are around, high 90s, close to $100, but the traders were, looking at maybe 120 plus if the U.S. were to again begin attacks on Iran, like Trump had previously mentioned when the ceasefire would end. There's been a lot of fear that the longer that this conflict continues, while we are in a ceasefire, that raised the risk that there could be an increase or a revitalization, a restart of attacks across the region, which could hit Saudi Arabia, Qatar's LNG export plant. Any other attacks across the region, like we saw last month, would increase prices and raise the risk that oil production and shipments of fuel from a lot of these countries could be disrupted far longer than even if Hormuz were to open again.
Stephen, there's some talk that Iranian tankers are getting out. They're hugging the Iranian coast, the Pakistani coast. They're getting out into open water. What do we know about this? How much oil is getting out?
There has been some analysis from Vortexa and other groups that are indicating that over, on April 20th, when the blockade was well in effect, 2 shipments of Iranian oil, which would be about 4 million barrels, was able to get through. They were dark, so they weren't signaling their AIS. This isn't a huge amount. There has been really a trickle of shipments, even the ones that have gone dark. It's just a very limited amount of shipments that have gone through compared to 135 shipments that we saw pre-war levels of all types of ships. I think one thing that should be noted that while there has been a few ships that have gotten through the blockade, the U.S. has increased their effort to a degree to pressure Iran and Tehran and their ability to ship oil and other products. They boarded an oil tanker for the first time in the last 24 hours off the coast of Sri Lanka. That does indicate that they are taking this somewhat seriously. Whether or not this will be the policy for all shipments and whether they're going to go after these dark vessels as well remains to be seen. But at least boarding that one ship does indicate that they are trying to accelerate their effort to hold back Iranian flows from the region.
Stephen, great stuff. Thanks for the update. Appreciate it. Stephen Stupczynski, who leads our Asia energy coverage. That takes us on to our next story. Lufthansa planning to cut 20,000 short-haul flights from its European summer schedule in order to save on jet fuel, which has doubled in price, remember, since the start of the Iran war. Europe's largest airline group says the cuts will amount to 1% of available seat kilometres and save around 40,000 tonnes of jet fuel. At the same time, TUI this morning has cut its guidance. You see the same thing from Alaska Alaska overnight. United Airlines has reduced its guidance as a result of what we're seeing around the jet fuel crisis. Perfect time, therefore, to bring in Bloomberg's managing editor for aviation, Benedict Campbell, who joins us from Berlin. Benny, is this just the start of it? How much more of this are we going to now see?
Well, if you look at the news over the last couple of days, and you've read out some of them, it does look like things are getting a little bit more dramatic. We had Alaska Airlines on Monday saying they are suspending their forecast, essentially. Then overnight, we had United Airlines cutting back its full-year guidance. And then you just mentioned the Lufthansa announcement from late last night saying they're also cutting out some seats. Add to that Finnair, who said this morning that there is a real risk that fuel availability will become an issue. TUI, the travel operator, saying they are suspending their forecast. So you take all that together, the picture is becoming a little bit more dramatic, shall we say. At this point, it doesn't look as if there is a real risk of fuel shortage, but it's the price of fuel that is really creating lots of issues for the airline industry in particular. United Airlines, for instance, said $340 million in extra cost in the quarter that they had to absorb as part of that. So overall, it really is biting them. It's really eating into the earnings, and we'll probably get more of that in the next couple of days. We have Southwest reporting, we have American Airlines reporting, so that sort of drumbeat will likely continue.
So more to come, Benny. Fewer options, arguably, for flyers, and presumably higher prices all round.
Yes, exactly. And annoyingly, at a time where people are still looking into their summer vacation, thinking about booking, it's potentially good news for some of the low-cost carriers like Ryanair, who are very well hedged. People are reconsidering those long-haul flights. So people might think about staying closer to home, taking those shorter trips, both in terms of duration and distance. So that might really change people's travel plans. Again, nobody quite knows what's going to happen. The news that we're getting out of the White House are sort of mercurial, and things could get easier very quickly, but it won't happen overnight. You still have refineries that are producing a much lower capacity. You have damaged equipment. You have a system that is essentially out of sync at the moment, and that is something that will probably last into the third quarter and maybe towards the end of the year, which is why you have a lot of airlines taking a far more cautious view of the rest of the year.
Benny, does Europe have any stores of jet fuel that can be brought online? Like, how much reserves exist in this part of the world?
There seems to be enough reserves. The airlines that we've spoken to so far, nobody's really coming out and saying we are sort of on the fringes of what we have. Things are getting tight. There is the perennial sort of competition, shall we say, between the military part of flying, which has obviously increased dramatically since the beginning of the war, and the civil part. And right now, more precedent is given to sort of military operations. So there might be some shortage over time, but for the time being, again, it's less the availability of fuel and more the cost of fuel that is really wreaking havoc to the industry.
What do you think, Benny, is the longer-term story for the industry? Is this an industry that works with governments to build out additional reserves and capacity longer term? Is it an industry that spends more on alternative jet fuels? What are the longer-term implications, do you think?
Well, I do think one thing that will happen is airlines will take a very hard look at the routes that they're flying. And you've already seen it over the last couple of weeks. They are weeding out capacity. They are taking a hard look at some of the flights that were sort of on the cusp of being profitable previously and now are deeply unprofitable. That, for the consumer, means fewer choices. Lufthansa, for instance, said they are cancelling their Frankfurt to Stavanger flight in Norway. Now, you could say, well, there's not that many people who need to fly from Frankfurt to Stavanger, but for those who do, that is a problem, and you're going to see more of that going forward. That these sort of secondary and tertiary routes will get dropped. You have less optionality. That's going to be one thing. There will be quite a lot of lobbying between airlines and the government side to reduce some taxes, to make tankering, which is additional supplies on planes, make that more of an option, just to sort of alleviate the overall sort of framework, the regulatory regulatory framework around this. And then ultimately, you might see some consolidation in the industry. As a result, the weaker airlines will become weaker still. We did hear from Scott Kirby, the United Airlines CEO, yesterday saying this might be an opportunity for us. Now, we did report a week ago that they have sort of casually looked at American Airlines. That might not happen, but there might be other deals that come out of this as a result.
Yeah, and it's going to be interesting to see who operates the most modern fleets, the most efficient fleets, and do they benefit as well? Do the strong get stronger, to your point, Benny? Thank you very much indeed. Bloomberg's managing editor for aviation, Benedict Camel. And our US colleagues will be speaking to Scott Kirby. He, of course, is the United Airlines CEO. That conversation starts at 2:15 p.m. UK time.
Just briefly, here's what else we are thinking about today. EU ambassadors will be meeting. We'll keep an eye on that and any potential loan extension to Ukraine. 12 p.m. UK time, the Prime Minister, Keir Starmer, is going to be speaking and taking questions at PMQs in the House of Commons. At 3 p.m. UK time, Eurozone consumer confidence. We'll break that for you. 30 p.m. UK time, we'll be hearing from the ECB's Christine Lagarde. She's going to be speaking in London. And on the earnings front, we've got Tesla, IBM and Boeing earnings later. Let's bring in Moena Cunningham right now from Bloomberg Markets Today, our editor. Moena, we've touched a little bit on what's happening in terms of CPI out of the UK. We were speaking to Santander about that with a view with The Economist, and CPI coming in slightly stickier. Just your line in terms of where this leaves the BOE. What's the view from market participants at this point?
I mean, it does. It's not unexpected. And it potentially does add, some more pressure when it comes to, how much they can cut those interest rates. I think what's interesting is the way the market is responding this morning is they are actually pairing some of the expectations of rate hikes. But that is probably a reflection of the broader market sentiment this morning, what's happening in Iran, which is somewhat overshadowing it. But I think, look, overall, what we're seeing is much higher fuel prices. And this is only March's data, so I think there's probably quite a bit to sort of trickle through supply chains. We are starting to hear that anecdotally. We're seeing that coming through in earnings, such as from Reckitt Benckiser this morning. So I think there's more of that to come. But what we are seeing is those petrol pump prices being higher, really adding to that aspect of the CPI basket, and transport fares. I mean, we were just talking about airlines, really big increase there. Yeah. And that is going to, make it more difficult, I think, for the central bank to not sort of increase rates to try and curb these inflationary pressures.
Just very briefly, equity markets still largely ignoring a lot of this, though.
Yeah, so this morning, broadly across Europe, we're seeing stocks rise. The FTSE 100 is actually a little bit lower now, yep. But that comes down from those supply chain impacts, I think, on the consumer companies, a lot of that, and it's also missing out on a sort of resurgence in the tech optimism. And that's what tends to happen on more positive days for the wider European market, but very much a sort of overshadowed domestic data there.
Well, nice. Thank you very much indeed. Moena Cunningham, Bloomberg Markets Today editor. That's it. Got a tube strike out there. People are on their bikes, quite literally.
But it's beautiful weather, so that's one of the offsets. The Pulse is up next. This is Bloomberg.